Can you guys see the screen? All right. Here is the references. All right. Yeah, I'm going to keep the camera off. I think the camera is eating into the bandwidth. Okay. So I just want to show you guys the NASDAQ. We're going to go through this very quickly. Just because the connection seems poor. But yesterday we took a look at the just in case we took a look at the NASDAQ. The top chart here is the NASDAQ. The bottom chart is the real rate. In other words, what I want you guys to note is that the NASDAQ is coming down and the rate is moving. So I'm going to show you why, how the rate to move up. We call value of immediately equal future value. Okay. Future value. And then what we do is we put this all over one. Let me put this in bracket. 1 plus interest. Okay. Now this is a simplified formula. Okay. I want you guys to understand. And this is a simplified formula, but it will be enough for our explanation. Now, the present value is what's happening in the markets now. So we know that the markets are dropping. Okay, the NASDAQ is coming down. So the only way that the present value is going to be affected is either the future value is changing or the interest rate is changing, one or the other. Okay, so let's assume that the future value is 100. Okay, and it's going to stay constant. So we're going to go future value equals 100. And we're going to put in interest here of 5. Interest of 5. Okay, let me put an equal sign in there. So effectively, you're going to get a 100 divided by 1 plus 5%. Okay. Now, if you put that through your calculators, okay, what you're going to get is a present value of 95.24. Okay. That's at 5%, right? What we're going to do now is we're going to say, but wait a second, interest rates are moving up. Interest rates are moving up. Okay, so if interest rates are moving up, we're going to change the interest from 5%. We're going to make it 10%. Okay, make it 10%. Okay. So now we're going to put that into our 100 divided by 1 plus 10%. Okay. And if you put that into your calculators, okay, you get a different present value. The present value is lower. It's going to be 90.91. So look what's happened here. Interest rates have risen, okay, but present values are coming down. So what we can see is as the interest rate moves up, okay, the NASDAQ is starting to come down. Now there is a nuance here. We're going to just move this onto another level, okay? We're going to move this into another, we're going to use this into another lower. So a higher interest rate by the time value of money, it brings the Nasdaq down. Now, just be aware this is a slightly simplified formula because we've left out an exponent here, but we won't put that in. Now, let's just talk about this guy over here. Future value. What is future value? And this is where it gets really interesting, okay? This is where it gets really interesting. The value to be in the future. So let's assume that we're looking at a company and the company is going to grow and it's going to double, okay? So if the company is going to double from 100 to 200, okay? So now what we're doing is we change this and we expect sometime in the future that this is going to be 200, okay? And the interest rate is still 10%, right? What's the present value there? Okay. Can anybody work that out? Exactly. So Mia has got it. She says, if we've got 200 divided by 1 plus 10%, okay, that's going to equal 181.82. Okay, so the idea here, the idea of the time value of money is that, I'm just going to get rid of all of this because there's a lot on the screen, is that there is effectively a tension. There's a tension between the future value. There's a tension between the future value and a tension, and interest rates. Now this is where it gets tricky for us. It's tricky for me because we know in Dow theory that there are three stages. There are 3 stages to a bull market. Okay. So what are the 3 stages? There's something called renewed confidence. Renewed confidence. The second stage. Now, this second stage is where future value is going to really be impacted. Improved earnings. So as soon as you start getting improved earnings, your expectations for future values start improving, right? That's why the market's always discounting the future. So that's what FV is. And then we have what we call rampant speculation. So at the moment, we have a market that's been dominated by interest rates. Now, what's going to happen is we're going to have to see if there is going to be a movement up here despite the interest rates. If there's a movement up despite the interest rates, what I would suggest is that we're actually starting to move towards improved earnings. But that's very much a hypothesis at the moment. That's something that we can't take at face value just yet because we're not moving up, we're starting to move down. And we want to see if this is actually a higher trough. Okay, so if I go now and just take a look at the weekly chart, I'm going to put everything together in a moment. So just bear with me for one moment. Okay. Let's take interest rates out. Let's take the Bollinger Bands out. Okay. And now, what happens if we get something like this? Something like this. In other words, we still, even though interest rates may be elevated, well, that would be the tension between future value and interest rates. So I just want to put everything together now, and then we'll conclude. We've got this we've got this formula. It's a very important formula. It's future value divided by 1 plus interest. And if we really wanted to be, we can put to the time, okay? But we'll leave that out, all right? And what happens is there's an interplay between future value. Let's do it the other way. There's an interplay between future value. So will there be improved earnings, okay? Or is the interest rate going to be completely dominating, okay? And what does this equal to? This equals what we're seeing in the markets right now, equals the present value, okay? Equals the present value. So the idea here is we've got to try and be quite savvy here in that which is the greater force? Is the greater force the future value, or is the greater force at the interest rate? Right now, it seems as if the greatest force is the interest rate, and we've got to respect that because we saw yesterday that median inflation is going to be really a problem for the Fed. The Fed's going to have to fight that median inflation. So we've got this tension. This is called the time value of money. If you want more information on it, just Google time value of money or go to YouTube and type in time value of money. And there's some really good, information out there. All right. Just because of the slow internet, we're going to conclude at this point. I apologize for the beginning. I hope that this was clear. If it wasn't clear, just send me an email and we can redo it. I'll just put my email address down again. All right, and we can take a look at it again. I feel it was maybe a little bit of a rush job just because I'm a little bit nervous around the internet connection. With that all said, let us conclude at this point, and we shall meet up tomorrow. Have a good day and a good evening ahead. Thanks very much, guys.